Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Trading, bringing you the Forex Trading 101 video series. In the first three chapters of the Forex Trading 101 series, we covered why Forex, why we trade Forex, why is it important. We talked about in chapter 2 the major currencies. What are the major currencies? The US dollar, the euro, the yen, the pound, those major currencies. And then in chapter 3, we talked about the definitions of trading currencies in terms of a currency pair, currency pips, and so on and so forth. So it might be good to go back and review those as we continually get better and better in terms of our knowledge level regarding trading currencies. In chapter 4, we're going to get more technical, and we're going to talk about technical analysis. Technical analysis is the study of price action in history. If there's one thing we know about history, it has a tendency to repeat itself like a wheel, is this cycles just go over and over and over again. And how we study technical analysis is we do it in a three-step process. The first thing we do is we always identify the trend. We identify the trend to know the direction we want to trade the currency. The second thing we do is we identify the pattern to know the probability of the immediate next movement. Probabilities are not certainties, they're not guarantees. They are simply more likely to occur than not, or greater than 50%. And then the next thing we do is we identify support and resistance to determine where we want to buy and where we want to sell, where we want to place stop orders, entry orders, target orders, and so on and so forth. Now, technical analysis works on everything, so the things you're learning here can certainly be applied in your retirement accounts, on your mutual funds, on your IRAs, on the individual stocks you own, or any time frame of the chart as well. So if you're day trading and you're doing a 5, 15, 30-minute chart, or if you're swing trading and you're doing a daily chart, or if you're long-term investing and you're doing a weekly chart, technical analysis is consistent on every time frame out there in the marketplace. Technical analysis is also one of the most important principles that we utilize, because out in the marketplace, it's the one thing that simply doesn't lie. Everything else out there, it's really hard to trust kind of what we're hearing out there in the market, what we're hearing from Wall Street, what we're hearing from the Fed, what we're hearing from your financial advisors, because they all have basically they all have at some degree, they receive something for you maintaining some degree of retirement accounts and whatnot, and buying the things that they are selling, such as mutual funds or so on and so forth. Now, in terms of trading, let's first define the trends. You have three basic types of trends. The first trend you have is what we call a bullish uptrend. In a bullish uptrend, this is where you assess, not you believe or you think, this is where you assess that the currency that you were looking at is going to continue to go higher. Keyword in that, continue. It is already moving up. It is not sideways. It is not down. It is already moving up. It has set a higher high. It has set a higher low. As you can see right here, it is setting a higher high. It then retraces back down to set a higher low, and this trend has a tendency to continue because things in motion have a tendency to stay in motion. The second type of trend that we have is what we call a sideways neutral trend. A sideways neutral trend does not have higher highs, higher lows. It doesn't have lower lows, lower highs. It is flat neutral. In a sideways neutral trend, we do not want to really do anything to the currency. We do not want to buy, we do not want to sell, because you can always go find a trending currency. For example, in a bullish currency, we definitely want to be a buyer. In a neutral, we want to shy away from it. And then in a bearish downtrend, we want to be a seller. We want to make money as it goes down. And so basically the currency is already going down, and will have probabilities to continue to go down. So as a trader, we don't care exactly what direction the currency is going to go. We just care that it goes one way or the other. Now, in neutrality, there are strategies that you can apply long term, such as the carry trade, and we'll talk about that in future editions of the Forex Trading 101 series. Now, let's talk about support. Support, trends, pattern recognition, we all kind of put it together. Support is the area on the chart where you basically assess it's going to start going up. So you have a support catalyst. A support catalyst can be something that can act as support. Support, by definition, is only an upward movement in price. So you have 5 basic support catalysts out there in the marketplace, and any of them can act as a support level, and oftentimes you will have multiple levels at the exact same area. For example, the first one is a prior pivot, which means in the past, old resistance can certainly act as a new support level. You can have moving averages, the 20, 50, and 200-day simple moving averages. Those can act as support levels. For example, the 20-period SMA can act as a short-term support level or a minor support level. The 50 can act as an intermediate, and the 200-day it's basically trench warfare on the 200-day, where you have the buyers and sellers really fighting for long-term position. Trend lines, and in drawing trend lines, I've always made the analogy of connecting the dots like a coloring book, and you teach your child to connect A to B to C to D, or 1 to 2 to 3. Well, that's exactly what we're doing with trend lines. The more dots we can connect, which means the more support levels we can connect over time, will mean that support level is stronger. You can also have significant whole numbers that act as support level. $1, or $1.25, or $1.50. These levels can act as psychological levels and certainly can play a key role in identifying support as well. And then you have Fibonacci retracements, which is typically my standard go-to in identifying gold support levels. And you have 3 basic old Fibonacci levels. You have a 38.2% retracement, a 50% retracement, and a 61.8% retracement. And it's think about it like this: if something moves up 100 pips and then it retraces back down 50% retracement, it will retrace back down 50 pips. Or if it goes up 100 pips, it will retrace 38 at a 38.2% retracement. And so that's what the percentages are. It's just a retracement off what the prior movement was, and very, very, very popular amongst technicians. For example, this is a current view, a current chart of the U.S. dollar Japanese yen pair on a daily chart. And what you can see here is you have a prior pivot all the way down here. This is old resistance. These are your Fibonacci retracement levels right here. This is bottom one, that's a 61%, that's a 50%, that's a 38.2%. This one's a 23% retracement. And then as you can see, I've connected my dots, which means I've connected my support levels to draw the trend line here. It's difficult to see, but you can also see a red moving average there. So as you can see, this currency, the dollar, because it's a base currency, is retracing back down into a support level right here. All of a sudden, well, where is that support level? It's right at the 20-period moving average. It's right at your trend line, and it's right at a 50-period Fibonacci retracement as well. That's what I would call a very powerful level of support. If this support level is broken eventually, more than likely it's going to come back down to the 61%, or probably even all the way down here to the prior pivot. So this support level, since it's already starting to go back up, is a very important support level, which means if you're a buyer at this level, you'd want to place a stop loss right underneath that level. That's how important identifying support is. Resistance, very, very similar. As you can see, you have the exact same levels, resistance catalysts that you have as support catalysts: prior pivots, moving averages, trend lines, significant whole numbers, Fibonacci retracement zones, and so on and so forth. So over here we have the same levels, but instead of connecting support, we're going to connect resistance. So now look at this here: resistance, 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 and then it runs right into that same area. I would call that trend line a very, very important trend line. And one thing that you could do is, if you use that trend line, you could trail the stop loss down right above that trend line as well. Well, where else is it coming right into? It's coming into the 1.40 range. That 1.40 range is a significant whole number. It's coming into a Fibonacci retracement zone of 38.2%. And so we're looking at this same resistance zone, and you're seeing multiple levels of resistance right there. That's going to play to a very important level of resistance as well. And so as you can see, the US dollar retrace back up here. It then confirms, and it starts to go back down as well. Another thing that can help us identify support and resistance, because that's where we buy support and resistance, is our candlesticks. Candlesticks can basically tell us who's winning the battle on a daily, a weekly, a 5-minute basis, depending on the time frame of the chart, can help us determine who's winning the battle between the buyers and the sellers out there. And so when we're looking at candlestick analysis, for example, there are so many different candlesticks. I mean, just absolutely an ungodly amount of candlestick analysis out there, whether you're talking dojis or haramis or engulfings or piercing lines or dark cloud covers or hammers or inverted or the necklines or the long lower shadow or the bar confirmation or the tweezer bottoms or you name it. There's just so many different candles. But I will tell you this, in all the different candlestick analysis that you can do, you can either make it complicated or you can make it easy. I have a tendency to like to make it easy. In every single one of these candlestick formations, you have two basic candles. They are the wide body and they are the narrow body. Now, wide body candles have a tendency to continue because they are momentum based candles. As you can see right here, wide body candle breaking out of resistance, and what happens to the stock? Boom, the currency. Boom, 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 continues to drive up. As the currency is coming down, 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 you have this narrow body candle formation down here, and it's coming into a support level, and all of a sudden it goes up, 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 up. And so you have these wide body, narrow body candles, and truthfully, it doesn't matter if this is a doji, it doesn't matter if it's a spinner, it doesn't matter if it's a morning star or harami. They all say the same thing, that the currency on this downward movement is coming into support. The currency is now losing momentum, upward movement in price. That's confirmation. That's easy, ladies and gentlemen. You can get into there, put a stop loss right underneath that level, and you're raring to go here. It doesn't matter if this technically is a bullish harami. It is a narrow body candle. Narrow body candles are slowing momentum candles, which are slowing the prior momentum, upward movement in price, and then you're raring to go here. Here is your expanded candle, and as an expanded candle, I also refer to them as wide body candles. Yes, I know wide goes horizontal, expanded goes vertical, just my language. So an expanded candle range, it has a tendency to continue its momentum. Now you have all these different candlesticks, but where they are most important is at key levels of support and resistance. This is a narrow body candle in the same capacity that this is a narrow body candle. But why is this not a buy signal and this is? It's because this is coming into a support catalyst. This was a 50% Fibonacci retracement. This is nothing. There's no support here. We're not going to buy it at a non-support level. So the candlestick analysis means a lot more at key levels of support and resistance. For example, this wide body, the expanded candle range, breaking out of resistance is much more important than this wide body. And this is certainly a wide body candle as well, but this one's breaking out of resistance. Here is a bunch of narrow body candles right here, but they don't mean necessarily as much as these narrow body candles do here, because this is a 100% Fibonacci extension level, which is a resistance level target. So the candlestick analysis is very important. Narrow body, expanded body candles at key levels of support resistance help us identify when the patterns are really starting to form. And in pattern recognition, these patterns have a tendency just to repeat themselves. For example, if I got a triangle, rectangle, triangle, rectangle, triangle, if that pattern continues and it is likely or probable to continue, you should have a what? You should have a rectangle, and lo and behold, it is a rectangle. Here's another one: star, star, arrow, star, star. What is the next candle? Oh, what is the next pattern? Well, the next pattern is, if this continues, and once again is likely or it is probable, is another arrow. And so we simply identify historical patterns to determine the future patterns. And this is fairly easy. Triangle, rectangle, triangle, rectangle, triangle, rectangle. Star, star, arrow, star, star, arrow. But when you look at a chart, you might think it's a lot more complicated. It doesn't have to be. Charts just have more bells and whistles on them, but you have a very similar pattern recognition. And we here at Tackle Trading, and there's a lot of ways to teach it, ladies and gentlemen: higher highs, higher lows, motive waves, corrective waves. But we here at Tackle Trading, we teach it through the 1, 2, 3 bullish pattern, because we teach it that way because it's easy to understand the 1, 2, 3 pattern. Down the road, as you get more advanced, as you get better at technical analysis, and as you start to really kind of focus on some of our higher level classes out there, we'll teach it in terms of motive waves, corrective waves. We'll teach Elliott wave theory. We'll teach Fibonacci extensions and retracements, and how it all works within the exact same pattern. But as you're new to trading, let's just keep it simple here. Okay, I've known a lot of great traders. I've known amazingly great traders. But I haven't known a lot of great traders who can also teach other people how to trade. That is a very vastly different skill set, and it's one thing that I feel that we are very good at tackle trading is taking advanced concepts, break them down into this simple terminology and simple ways that we as retail investors, we as retail traders, as individual traders, that we can understand as a collective. So here we got resistance, and once again, we all know what resistance is by now. It's always above the currency or the stock, and it's driving it back down. Once this level of resistance is broken, the currency will have a tendency to drive up. The reason? There's orders. There are already orders in the marketplace above resistance levels. Once that is broken out, those orders will simply continue to drive up. So we place a buy order right above resistance, or we wait to see it go above resistance. One is aggressive, the other one is conservative. The aggressive way, you place your order above resistance. You get it out there in the marketplace, waiting for it to break out. If it doesn't break out, so what? You can always take the order out. But the conservative approach has a little bit higher probability, but you can have less return versus the risk. The conservative approach is to wait for confirmation, which is for the candle to actually close above that level of resistance. Well, we're going to place an order here. It gets triggered in, so we trigger a buy order right above resistance. That's the one pattern. It is called the breakout buy. So the breaking of resistance, buy, the breakout buy, and then we come into pattern number 2. Pattern number 2 is what we call the overextended sell. It is also called a contrarian trade if you actually make the trade, but for the most part, this is just selling back the position that you bought in pattern number 1. When you sell it based on what you bought in pattern number 1, that is going to drive the market back down into support called the retracement. The retracement buy comes back into support, and we now know how to identify that, whether that's through trend lines, moving averages, significant whole numbers, prior levels of resistance or new support or Fibonacci levels. And we also know how to identify when support is actually forming through the candlesticks. Once we get that upward movement in price, that is where we got buy. So we have the 1, 2, 3 pattern. 1 is the breaking of resistance, 2 is the overextended, and the 3 is the retracement. So we buy in patterns number 1 and 3. We sell in patterns number 2. And down here on the right hand side here, we got a bullish trading instrument guide. Long stock, buy to open. Long call, buy to open. Long futures, long currencies, position size, all of that jazz. You really can use this in multiple different capacities. Now, the 1, 2, 3 bearish pattern is the exact same. You have resistance and support. Instead of breaking resistance, this time we are breaking support levels. So we're going to go out to the market right underneath this support level right here. We're going to place an order to sell. Once it triggers underneath support, it triggers our order to sell, drives the currency down, 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 down. Big momentum based patterns. Then it comes into pattern number 2. This is the overextended buy pattern. And so now we come into the overextended buy pattern, and we're not necessarily really buying the currency. It's just we're closing the trade that we did in pattern number 1. So in pattern number 1, when we sold, pattern number 2, now we are going to buy back what we originally sold, which will basically, close the trade is what it does. But through that process, the currency will go up, 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 back up into resistance, and we call that the bearish retracement or the retracement sell. And again, where can resistance form? Prior pivots, moving averages, Fibonacci retracement levels, significant whole numbers, trend lines. Once it comes into one of those resistance catalysts and we start to see the slowing momentum of the candles, and then we see that downward movement in price, that is where we are going to get back into the position. Now, in all of this, Okay, visually we can identify pattern 1. Visually we can identify pattern number 3. What we cannot visually really kind of see happening at the time is pattern number 2. And so in pattern number 2, we use what's called the average cycle, the average true cycle of the currency or the commodity or the stock or the fund or the market itself. We call it PAY, potential average yield. One of my amazing mentors, Jeff Crystal, is who really came up with the concept of potential average yield. I dubbed it pay range. And so in terms of potential average yield, it is truly just the average cycle between two different price points in terms of the motive waves, corrective waves, the higher highs, higher lows, to give us a price target. Now, pattern number 2 can also be done through what's called a Fibonacci extension, 61, 100, 161% Fibonacci extensions, but that's a little more advanced than we want to get into in terms of the Forex Trading 101 series. So if we have a currency go from 1.1, which is $1.10, to $1.1250, that's a 250 pip movement. So the first higher high moves up 250 pips. At that point, that's going to start locking in profit. The traders are. It's going to start driving it back down into support. We'll just say, just to make the math easy, we'll say it comes back down into 111. And that's $1.11, and then it goes back up another 250 pips up into $1.1350. It then retraces back into $1.12, and so you have this very, very a standard cycle going 250 pips up, then it retraces, 250 pips up, it retraces, and so it's that cycle which is now 250 pips. So if we're looking at this from $1.12, and that's where support is now forming, we already have confirmation going up. We know we want to buy right above $1.12. We know whether that's $1.1250 or wherever confirmation is. We know we want to place a stop loss underneath $1.12, probably typically 1/2 ATR underneath that level. And now we're looking at our third thing we want to know. Where's our target? Where's that pattern number 2 going to form? Where is the overextended pattern where we're going to lock in profit? And it's based on the average cycle of the prior movements, which are 250 pips, which would be $1.1450. $1.1450 is where we would target. So that is technical analysis. That is potential average yield. That is trend analysis. That is pattern recognition. That is identifying support and resistance. That is how we go about doing our business as a trader, both in the Forex market, in the stock market, in the commodities market. That is the Tackle Trading 1 video series known as Forex Trading 101. This is Matt Justice for Tackle Trading. Hope you enjoyed the video series on technical analysis today. In Chapter 5 will be coming next Monday or Tuesday, so enjoy that as well. And if you have any questions, obviously go out to the forum there at Tackle Trading, and you can also hit me up over there. You can hit me up on the comment section of this blog post as well. Matt Justice, signing out.